Hello and welcome to today's episode of Nucleus Investment Insights. There are many imbalances, uncertainties facing the world at the moment, and today we're going to ask the question, which economic imbalance will be the first to crumble? On the agenda, we'll have a look at the imbalances in the US, Europe, and emerging markets. Then we'll take another look at the unfolding Chinese property crisis. Next, we'll look at the extremely high Australian household debt. And then, as always, at the end, we'll look at the market implications. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome one of the founders and the Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, welcome.
Hey, Sam. Hey, gang.
Good, thanks. We're also joined by one of the other key founders and our Chief Strategist, David Llewellyn-Smith. Dave, welcome.
G'day, Sam. Thanks for having me.
Thanks for being here. So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform as our show's available on all the majors. You can also ask any questions for those of you watching live, and we'll do our best to answer them during the show. And as always, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view those in the episode at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damo, I'll hand it over to you to lead us away.
Yeah, so this is the second part of the look we had last week at central banks, and so the idea is. What we're really focused in on is that we've obviously got all our central banks ratcheting up interest rates at the moment, and the historical tendency tends to be that central banks keep increasing rates until something breaks, and at that point then they slow down or pause and wait to see how much damage, and then at some stage reverse. And so given that and a little bit of excitement this week with Credit Suisse as being, well, is that something that is broken? We thought we'd focus in on sort of 5 different areas. So we're going to look at the imbalances in the US, imbalances in Europe, imbalances in China, emerging markets, and then Australia. We have left Japan as sort of, I guess, as a major economy out of that, but I guess partly because we didn't have a lot of interesting things to say. We think something that pops up is more likely to be in one of these other areas. So with that background, I guess I want to start off on in the US and US corporates. I might let Dave, I might hand across to you and I'll jump in where I need to.
Sure. So, well, the good news, or at least different news on this cycle, is that US imbalances are not critical at this point. And so as the Federal Reserve hikes rates, it does have the highest inflation worldwide, or has done. And part of that is a very tight labour market, but I wouldn't characterise that as an imbalance. Traditionally the areas of overextendedness, if you like, that you would expect to see in the US at this stage of the cycle, like at a mature cycle, are not there. So US corporate lending, for instance, generally spikes into the end of the cycle. At the moment, yes, the ratios of debt to GDP and other things are at record highs, but in fact, in part owing to all of the fiscal transfers that came with COVID, the interest rate burden for corporations is quite low, very low, in fact, for a late cycle. And so it doesn't look like there's an accident coming there. Most certainly there will be accidents if the Fed keeps hiking, but not a systemic accident. And you can see this chart from Pantheon, which, to just give you some grasp of how huge the fiscal transfers were from the US government to corporations, and you can see almost 6% of GDP was transferred to corporates as cash virtually. So they were given a lot of money, a lot of support. Now,
And so it's worth noting, sort of along those lines, Dave, you spoke about sort of there being sort of record high debt levels to GDP, but it's record low interest burdens to GDP.
yeah,
And so corporates tend to borrow on sort of a 3 to 5 year basis, tends to be what most of them sort of so the length of the debt that they take out. So if you sort of took a view that higher interest rates are going to flow through to corporates over the next 2 to 3 years, as you sort of get that average maturity of the debt, then you can sort of see even if we went to sort of quite high interest rates, it's going to take a couple of years for this to flow through and start becoming a broader spread. Now, obviously, as David said, there'll be ones that'll pop up where companies, have got they're just rolling off and they've got to go from a lower rate to a higher rate, and they're really depending upon those low interest rates to keep the whole thing going. And this is going to hit profitability as well as these interest rates rise. But as you can sort of see from that chart, it's a little while away. So if we're not saying there's no chance of US corporate, it just seems like in the short term, or in over the next year or so, there doesn't seem like a lot that's going to break there.
Yeah, I mean there are always your WorldComs and Enrons and what have you at any given cycle. So we'll certainly, I think, see some bankruptcies, but just not a systemic crisis. So the second area of concern that would readily spring to mind for viewers would be US households, of course, which is what dragged the world into the GFC after their crazed housing bubble, leading up to 2008. And the good news keeps coming there, which is that post the near bankruptcy of the US banking system, US households deleveraged enormously and remain pretty deleveraged to this day. And this is despite the fact that we've had a ripping house price boom in the US over the last 2 to 3 years, which is a bit of a mystery, to be perfectly honest. And we've certainly had rising mortgage debt, but not so fast that it really, caused any critical ratios to blow out. And so again, even if as interest rates rise, we are starting to see naturally US house prices roll over in the last few months and starting to fall, just as debt capacity is reined in with higher interest rates. But it's again, there's no real kind of macro scale imbalance here to adjust, and so we could well see house prices fall for a couple of years without necessarily triggering any kind of reckoning in the banking system. And so, again, this is not an area that looks like it's imminently going to cause any kind of crisis. So the area where we did see some really extended ratios and some all-time high prices was in fact the equity market in the US. And I think it's fair to say that this was something of a monetary bubble with all of the COVID support and in fact all of the monetary support that came after the GFC, sort of instituted this new era of high valuations for a decade, or high multiples for equities, which really blew off with COVID. And we hit, as you can see from this chart, we hit, all-time high multiples on the S&P 500. And that has now substantially corrected. So this is one adjustment that is underway. And I do think that it will have macro implications, this. I mean, there was some debt behind it, margin lending, what have you. But stock markets bubbles tend to, as they deflate, rather than hitting banking systems or leading to debt crises, they tend to just land on consumption ultimately, and corporate investment as well, just because of wealth effects and stuff, and declining 401ks, and which is the US superannuation system. So I do expect this to continue to fall, and there is a reasonable correlation between US household confidence and consumption growth and the stock market. So, I think that this is probably already having an impact at the margin on US consumption, and will continue to do so, especially if it keeps falling. So, this is probably the key kind of financial imbalance, I think, in the US at the moment that is already unwinding and will have further impacts.
And so it's worth noting as well that, as we've been speaking about for months now, is that the earnings part of that still hasn't really been. It has rolled over a little bit, but it hasn't really been hit yet. So I guess what I'm saying is you could see the current multiple, say, staying roughly where it is for a year or two, and you can still see 10-20% downside in terms of stock markets just because the earnings are actually falling at that point. Yeah.
Excuse me. So assuming that the stock market or just rising interest rates and increasing interest rate burden does ultimately land on the economy in a demand sense, which I think is the base case. That's what the Federal Reserve wants to see, and so we think that they'll persist until it happens. Then you have a second kind of cyclical imbalance in the economy there, which is pretty important for the global economy. And that this is not your typical macro imbalance that you would see, like overextended debt ratio, etc. This is more, which is sort of considered structural. This is more cyclical in nature, and it's inventories, as simple as that, where we've been through this huge supply side squeeze through COVID, with inflation running wild, nobody able to get a hold of anything in their supply chains, and it triggered an enormous hoarding cycle in wholesale inventories in the US, which means basically everyone's just sitting on piles and piles of stock of everything. And so you can imagine there are two things that are happening right now as the Federal Reserve continues to tighten. One is that demand is starting to diminish, as the rising interest rates have their desired effect. But the other is that we've had this supply side squeeze for long enough now that there's been, lots of attempts to invest into fixing it, and then you've got a diminution in expected demand, and so suddenly you've got supply side excess, right, in the supply chains, and so we're seeing this in crashing logistical rates in shipping and everything else. We're starting to get profit warnings. We had an absolute classic from Nike last week, or this week actually, that completely beautifully summarized this. They just said we're just sitting on piles and piles of shoes. We need to move them. And so two things happen then. You get a whole discounting wave, which helps fight inflation, obviously. But the other thing is they don't order anything for a while. And that is a global shock. In fact, that is the key cycle that drives all recessions, is in fact this inventory cycle. So on this chart here, this is just wholesale US inventories. You can see that the accumulation over the last kind of 2 years has been unprecedented. And because the supply side stuff is now collapsing, all of the tightness, there's no need to sit on this hoard anymore. I mean, yes, there are still some concerns around conflict with China, et cetera, the sort of longer term stresses on supply chains and risk.
And companies might hold a bit more in their inventories than what they used to.
And they may, yes. But right now they're just sitting on a mountain, an inventory. Yeah. This is an inventory mountain. So
and I guess from that perspective, it's like going, well, if you used to keep an inventory of say 100 units, and now you want to keep an inventory of 200 units, we've gone to 300. And so you still need to wind it back. It might end up being above what it used to be, but it's most likely going to decline from here.
So this is what has been called the people might remember that the all of the supply side squeezes on the way up, which is like nobody can get anything, everybody panics, everyone piles in at once, and the further up the supply chain you go, the worse it gets in terms of tightness and lack of availability. It's called the bullwhip effect. And so we're now seeing the reverse bullwhip effect, as everybody's got too much of everything and prices are starting to collapse across the supply chain. And so there's going to be destocking. Now, that is just a classic recessionary dynamic where you have destocking in a major center of demand, and then that just ripples out through the global supply chains, and factories have to shut because they don't get any orders for whatever period of time it takes to destock, which might just be 3 months. Inventory cycles are not long recessions, but they can be deep-ish, but they don't come with the typical kind of financialized era recessions where you have balance sheet consequences. These are just basic, run-of-the-mill cyclical recession dynamics.
And they're usually the trigger for something bigger. So
they can be, yes.
In the Dalio version of long cycles and short cycles, the inventory triggers are these short little cycles that go up and down, and then you're in this big overall cycle. And what we're the other things we're looking at are really is this something? So say corporate debt just builds up and builds up and builds up over a long period of time, and then and you go through these various inventory cycles, and then one inventory cycle will be enough that actually turns the corporate debt into a corporate debt crisis.
Yes.
And I guess what we're saying is that of the ones we've looked at so far, this inventory cycle does look like it's turning, and it's ready to trigger something. It just doesn't look like the debt is at a point where it's going to get triggered.
In the US.
In the US, yes.
Yeah, so that's a really useful distinction, actually, Damo, long cycle and short cycle. So it looks like the US is in for a short cycle shock. The only thing that could potentially turn this into a bigger one, though, is that we spoke about this being an inventory super cycle, and as you can see from that chart, it's obviously way bigger than we've seen any time over the last sort of 40 odd years. If it does go back from, I spoke about going from 100 units to 300 units and then back to 200 as being this new sort of level that you're going to get at. If it actually went back to 100, that's a much deeper recession. We're just not expecting that at the moment. So. And we are expecting inventories to stay a little bit fuller than what they used to be. A little bit, but not hugely. I mean, if in your example, 100, and maybe they started stocking 200, I'd expect them to go back to 110. Right now, there's not a lot of reason as the supply chain collapses into excess to actually hold or hoard much. You're really talking longer structural risks like Chinese conflict in Taiwan or what have you. So I would actually expect a lot of this inventory to get run down. So anyway, so the US looks like relatively okay in terms of these various risks. Big short cycle risk though, and that's where we need to sort of pan out and look at the other imbalances around the world, because of course a destocking of US inventory is an export trade shock for anyone who's exporting into the US, and there are some very large economies that are doing that. So the first one we should look at is Europe, and this is Europe is very stressed and probably already in recession, if not also certainly awfully close, with its war and energy shocks, which are pretty incredible, delivering huge kind of price hits to everyone from households right through to corporates, in terms of electricity bills, gas bills, oil bills, and so domestic demand is already really weak in Europe, and that comes with the usual suite of political pressures in Europe. So we've just had an Italian election swing pretty hard to the right. Following that, Russia has cut off gas to Italy, and so you can see how hairline cracks in the European project could widen in this context, and could result in heavens know what. I mean, I'm not saying there's going to be a redenomination in Italy, but some of these risks are going to come to bear on spreads, market pricing, and yields and stuff. They already are. And so, something may crack there. And Europe's going to be hit by this unwind coming out of the US. This is all assuming the Fed persists.
Yeah, and this is sort of similar to what we were seeing last time, wasn't it? Back at the European crisis before, in terms of it being that if the grassroots population is upset with what's happening and they're not quite sure, they just know the economy's not right and that things aren't working, and they vote a party in, and the party, then drifts back into the mainstream, then the possibility is then they go, well, let's just vote for a more extreme party this time. And it's sort of been what's happening in Italy, where you get the right-wing parties, and then your right-wing parties, promising a whole bunch of stuff, and then they get sort of neutered by the central government, and so then we get a more extreme version sort of gets voted in, and the same process will most likely play out. And so the question is, do you just get a surprise somewhere where, and we saw it in Greece last time, but did you get a surprise somewhere where just real fringe parties pop up with some sort of crazier notions about what they're going to do? Well, yes. and arguably we saw that in the UK last week.
Yes, yes, quite right. We did.
The fringe element of a mainstream party took over and put in some crazy things, and
yes, and are now scrambling backwards. But yes, those risks are present in Europe. So in this sense, I guess we've got short cycle imbalance that's going to land on Europe, and some more long cycle risks there politically, and also in the banking system. Which is, where we come to Credit Suisse. You want to tackle this one, Damo? You're more au fait with that.
Look, I guess Credit Suisse. Look, maybe it is the next Lehman. Maybe it isn't. I think the moment it doesn't seem to be enough there to really send it under. But markets in the way you do get what they call crises of liquidity and crises of solvency. And so if markets decide that this company's illiquid and shouldn't be lent to and too dangerous to do stuff, then it runs into the problem that when Credit Suisse goes to refinance its existing stuff, it can't refinance it, and then it does start to create problems. And so, you can't say, you never say never on these things, but at a face value, just given the fundamentals, it doesn't look like it's going to be, it's been more Simone goals. But I guess it creates and the other part is, will they get bailed out by, if there were problems, would they get bailed out by governments? And the answer again is probably yes. But what I wanted to highlight is that bank profitability in Europe in general is very low. And I've got a return on assets, but you can measure this only a number of different ways. And what we've tended to see is we've got these, these very much over-leveraged European banks that have been getting support from the ECB because interest rates have been so low. So they've actually been, if they go out and give a mortgage to somebody, say in France, the ECB is topping that mortgage up, is basically giving the banks extra money for lending. They've had negative interest rates. And so there's already widespread support. Bank profitability is very low despite that widespread support, and debt levels are quite high. So we've seen a number of issues with Deutsche Bank over the time. You've seen sort of bailouts and bail-ins in various banks. I guess what we're coming to is, if you're going to pick a banking area where something could go wrong, Europe's probably it. Just given the nature of the companies there, how they've been performing over the last sort of decade or more, and the amount of debt that's there. So not to say you couldn't have a banking crisis anywhere. So as these rates ratchet up, we really are going to see whether there's some banks around the world that have been doing things that are fine at lower rates, but at higher rates all of a sudden don't make sense and can lose a lot of money very quickly. But the if you're going to sort of, if you're going to put the odds are that it's a European bank rather than somewhere else. And it's also worth noting some of these investment banks. There's strategies out there that they will have been involved in that relying very much on lower rates, and they're the ones that could be blowing up. As we see. And so you pick an investment bank as being more likely to run into problems than the more traditional mortgage banks at the moment.
Quite right. So we have, a US economy that's actually going okay at the moment, but is going to come under increasing strain with the Federal Reserve's tightening, which we think is going to persist for a while yet. They've got a bit of a sticky inflation problem there, running at about 5% annualized over the last few months. And then we have a Europe already in recession and at risk of external shock, as well as, whatever long cycle shocks may appear. And so what you basically got there is the two largest demand sources in the global economy in jeopardy at slightly different or mismatched timeframes and issues. But what it presents for the emerging market world, led by China, is a possible enormous external shock in the form of falling exports. And so we'll just swing over to have a look at the Chinese imbalances. So China, actually tried to do some very sensible things during the pandemic. It used what was an enormous export boom, driven by the big stimuluses in developed markets, which, as we know, were very goods based during the pandemic, and then have swung more towards services as things have opened up. And they've been very much benefited by, what we were talking about before with the inventory builds and the supply chain stresses. That's boosted all of their exports for the last few years. And so China's tried to use this external boom for a bit of internal deleveraging, because, as we know, it does have huge debt imbalances internally in all sorts of areas, especially state-owned enterprises, but arguably as well in households these days, which accumulated quite a lot of mortgage debt.
And I guess it's worth noting that the Chinese debt, when you look at Chinese household debt relative to the world, it doesn't look that high. Like, it's sort of 60%, and in Australia it's probably like double that, and US is like at 80% and things like that. But the thing is, for an emerging market, it's extremely high. It's right at the top, off the end of the scale versus emerging markets, because it's one thing to go, I've got somebody who's on a $80,000 as an average wage and got a big mortgage, and you're like, okay, they can afford to eat and still do all these other things. But when you've got somebody on an average wage of $15,000 or $20,000 and they've got these massive debts, that's where it's that's becomes an issue. And also, the Chinese household sector as a percentage of the total sector is very small as a country. So if you look at, say, the US or Australia or any of these developed markets, that the household sector is the largest sector in the economy, whereas in China it's actually very small. So you can certainly cut the figures to say, oh, it doesn't look like it's that bad, but you can also cut it a number of ways to show that Chinese household sector is very much indebted.
Well, the debt to income ratios are very stretched already. So, and you're right. Like, viewers may, at least Australian viewers may recall, that during our own semi-debt reckoning in, 2018 at the Royal Commission, 2019, can't remember. There was discussion in the courts about households being able to shed their habits of Wagyu and Shiraz in order to pay back their mortgages. But if you're on $10,000 a year instead of $80,000, then obviously that's a little more difficult.
You're probably not eating quite as much Wagyu.
No, you're probably not. But it's just all of your ratios are more extended and it's more difficult to cut. So they are a bit vulnerable on that front, but have been trying to actually fix it over the course of the pandemic. But the end result is that they basically overshot in terms of their property market weakness. Now, we're not talking really about prices here particularly. We're talking more about construction and construction volumes in particular of new homes, which have been such a key kind of pillar of excess Chinese growth for so long, and especially since the GFC. And so if we swing over to the next page, you can see how big this bust has been so far. It's been a very large fall in construction volumes, and there's a lot more ahead still in terms of today's sales and tomorrow's starts. So
I'll just describe this for anyone sort of listening in, is that we were looking at the Chinese property starts, the rolling annual, and sort of in 2007, 2008, when they were already talking about huge imbalances and building too much, it was sort of at a 900 on the scale. It sort of hit sort of almost 2 in the 2012 to 2015 before falling back, and we had this big slowdown in 2015 that sort of brought it back to 1.5. And then from there, we sort of boomed up again to sort of 2.3. I think it's billion. There's probably a few more zeros I might be missing. But yeah, and we've fallen right back down to sort of 2015 levels. But we could halve, from here and still be at levels where there's actually a lot of building going on in the Chinese. It's not. It would be back to a more normal. It could halve and be back to a sort of more normal economy level. And so, a true bust would be much lower.
And in fact, it will. It's really just a case of whether it happens all at once or over a longer period of time. So, so this is a big deal, in terms of the possible adjustment to a major, very major global imbalance, which is the excess Chinese property, which has led or been the key input into excess Chinese growth, which in turn has driven so much of global growth for the last decade. And so this is where I look really, I think most pointedly, for a possible accident if the US, does have a demand hiccup and then unwind this inventory excess into a supply chain shock for China. Now they're trying desperately to stabilize their property market without stimulating it. And they're having sort of not much success, to be frank. At some point, perhaps they will get some traction. I don't know. They certainly don't want to send it running off again for another cycle. That, I think, is pretty much a certainty now that they won't do that. But, can they kind of stop this free fall? Well, it remains to be seen. And I guess the point is, if they are smashed by an external shock, then it's going to get all the more difficult to stabilize this market. And especially, again, we're also in the context of zero COVID here. So this is a perpetually locked down economy in some measure.
And the other part is there's a psychological part of property. And in the past, whenever they've had these slowdowns, there's always been I think the expectation in China that the Chinese government's got your back and they're going to bail things out and spend more money and push this again. And so it was buy the dip. Property prices pull back. Here's my last chance to get into the property market at a reasonable price, and get out and buy it. This latest one has been longer and deeper and harder, and you got a question for a developer in particular. A lot of developers going to the wall and really struggling in terms of their debt loads. The question for them is, could you convince them, or how long would it take you to convince them that the Chinese government has really done a U-turn? So if they U-turn tomorrow, I guess what I'm saying is, if you're a property developer who's spent the last 3 years sort of juggling your finances and trying to stay alive and worried about whether you're going to default on all the debt, and then tomorrow the Chinese government turns around and says, "Hey guys, get out and borrow again," are you going to do it, or are you going to try and use that as a opportunity to actually get to the stage where you can see your company lasting and not sort of having those problems? I guess what I'm saying, it might take a year or two at least of in terms of changing, if they did change their policies before it take off. And so the question is, and we don't think they're going to change their policies, so which it gives it that more downside to it.
Yes. So this is where we see in Damo's distinction, we see a short cycle shock possibly hitting a long cycle adjustment, most critically. And so if this goes wrong, I've kind of used the analogy of Japan in 1989 for this, which is when Japan had used property itself for, at that point, nigh on a decade to support its excess growth as it went through its development phase. Through the 80s, it had become more and more property dependent, and then it had a major property correction in 1989, which really never ended, and it shunted its growth into a kind of deflationary perpetual 2%. And I could see this happening in China, no problem at all. Now, it would be different because it's a communist country, but it would also be the same. I think you're very likely to see extend and pretend for all the banks. You'd see them clogged up with bad debt, but it'd be perpetually rolled over and kicked out. And so it starts to choke productivity, and you get some pretty nasty deflationary dynamics. Now, China is at the same time trying to reform in other ways to lift productivity, and in part that is what this squeezing out this excess property investment is about. But there is a bad debt ball rolling into the banking system that comes with it, and so how that's handled, will factor in greatly into the impacts on growth. But anyway, so the possibility here is that China actually goes ex-growth. Would it be done via crisis? I mean, we've discussed many times the impossible trinity facing China, that is, managing interest rates, currency value, and capital flows all at once. You can generally only manage two of those, and right now that's looking very, very difficult. It's looking like that trinity is breaking down for China, and it's most obviously happening in that they've lost control of the yuan. It's actually been falling right out of bed despite the various controls they have around it. We've had some rises in the last week or two on a bear market rally, but it still looks very vulnerable. And as the yuan falls, then there's the possibility that capital flees China more and more, and you actually get rising yields as well, rising interest rates when they're actually trying to cut them to support this Chinese property bust. So I don't think it's beyond the realms of possibility that these converging crises, cyclical and structural, or long cycle versus short cycle, actually culminate in something that looks like a funding crisis for China, which would, in the end, I think, just result in something like has happened to Japan, like yield curve control, where its central bank is just forced to peg the rates where it wants it, and they just lose control of the yuan, which would ultimately have big consequences for trade wars, geopolitics, etc. But that would be a story for another day.
But actually, just put that in context as well. This weak yuan is exporting deflation to everyone. So
Yes.
It's making Chinese goods cheaper and cheaper. So it's helping to sort of keep the inflation story under control a bit more. And there's a whole bunch of other fallouts. But I guess at its heart, it's helping the overall situation. It's just there's problems that will come from that.
Well, it's certainly helping inflation. It doesn't help markets, however. Markets hate it. And if you look at the two big dumps in the S&P 500 this year, both have coincided with the yuan falling out of bed. Like they've just ticked down together. So if we do get another yuan accident, then you can expect stocks to take another leg down. So I think that's where there is a really large imbalance, global imbalance, that could possibly unwind into a structural change for the global economy going forward, is in China. So that brings us to the rest of the emerging markets, because what we've described in China there is more or less a pretty typical emerging market crisis, where a falling currency, rising inflation, and or falling asset prices leads to fleeing capital and a rundown in forex reserves, and a sort of feedback loop of fleeing capital and troubled external accounts, and et cetera. That's more or less the story of what happened in the Asian financial crisis. The various ones you can go back over, the Mexican crisis, the Latin American crises, they all have similar dynamics, not the same, but similar. And so I can't really point excuse me, to any particular emerging market, but we are seeing a lot of pressures coming to bear on their yields right around the world, as the US dollar rises with the Fed tightening, and capital flows out and into the US, and then you add the falling yuan and rising Chinese competitiveness, and that hits them on the trade side as well as the capital side, and so you can see how both of those together start to make markets doubt the sustainability of their external accounts, and that just feeds the beast, and the capital flees even more.
And I guess, though, I'd say, David, although you're saying you can't highlight any, it's worth noting that Turkey's sort of been rolling through some systematic problems for the last few years. Sri Lanka's had some shocking issues. It's any one emerging market is probably not big enough to cause problems outside of China. It's more likely to be a crisis that sort of rolls through a number of them in terms of the same characteristics. As you spoke about, the problems with the lower Chinese yuan, meaning that they get substituted. They start losing out on their exports. Also, China imports less because the prices of the commodities that these countries are selling, China hits in terms of China. And the external debt, and so there'll be a number of characteristics you can see, but it's more that it'll roll through a number of different ones, like we saw in the Asian crisis, rather than it just being. So I think if the Asian crisis had been Thailand on its own, would have been fine, likely for most other countries. But if it's same characteristics, and that's where you can see an emerging markets sort of problem.
Yes, well, and of course, there's always the possibility of someone being ludicrously long or on the wrong side of an emerging markets trade, a kind of long-term capital management issue as well, a default somewhere that triggers a cascade in Wall Street leverage. There's always that chance as well.
Yeah, and just to put that in context, long-term capital management was sort of the late 90s, and effectively what they were doing is just a very, very big hedge fund that just took some massive bets on, I think it was Russian ruble at the time, but just really big bets with lots of leverage behind it, and so when they came unstuck, and then they had all these other massive trades out there that they were trying to sell themselves, and everyone found out what their other trades were, and so started trading against them. And so while a lot of the other trades were actually relatively low risk, the fact that everyone knew what they were and could push them and try and break the system, so to speak, meant that that had the potential of sort of pulling the market under.
Yes. So there's always that black swan element to all of these things. So that brings us to our own little backyard, and how Australia fares in all of these deteriorating dynamics.
Hey, Dave, I might just jump in there for a second. We've got a viewer question come through from Carsten. So he's saying everyone's talking about a leg lower due to earnings downgrades, but if everyone's expecting it, is it not already priced into the share market, or is it creating sort of a low bar for an upside surprise?
It's an excellent question.
Yeah, well, I mean, I would say, is everybody talking about it? Because analysts haven't downgraded, so the consensus is that the downgrades aren't coming. I mean, certainly, there's no doubt the market's been oversold at various points, including up until this week when we've had this explosive rally. So I mean, we're already seeing what you're describing, Carsten, with an explosive rally to the upside. And there are other factors, like, for instance, right now, US growth appears to be rebounding over the last few months, with oil prices falling away and a little bit of fiscal support going into the midterms, and that might be enough to sustain margins for another quarter, and so you may not see the downgrades. But I would argue that all of those things are self-defeating in the sense that they've still got a sticky inflation problem. So any sustained strength is going to result in interest rates going higher. That's the first point. And the second one is this reverse bullwhip effect is going to be terrible for margins. And like US corporate margins hit record highs during this inflation burst. And it's just going to go the other way because, instead of having everything tight and pricing pressure everywhere and pricing power everywhere, you'll have the reverse. Everything will be loose on the supply side. Everyone's got too much inventory. Everyone's destocking and discounting, and and wage growth is still strong, and so you'll get a margin crush. And I'm not sure that dynamic is priced into the equity market. In fact, I don't think it is. Like most of the falls so far, I think have been more a derating than an actual kind of adjustment to the reality of what's coming. But it's a fair point, and I as we're seeing right now, we're going to see big bear market rallies, and when it gets overstretched and this discussion does reach consensus, then absolutely it will be time to buy.
And the other thing I'd note is that how these tend to play out, as Dave was saying, the analysts are usually the last, well, not the last to downgrade, but they're well behind the strategists. So the strategists sort of have this view about saying, okay, the markets are we're looking at all these forward indicators, and we're looking at interest rates, and we're looking at the slowdown and inventory cycles and all that sort of stuff, and we think there's going to be a big earnings downgrade. Companies themselves are basically still asking their salespeople, how are you going? And they're like, well, we sold 10% we increased sales 10% last quarter. I'm guessing we'll probably do the same again this year, or it's a little bit weaker, and so maybe it'll be only 8 or 9%. They're not building up their forecast by looking at the fundamentals and the way the economy is turning. And so at turning points, they tend to be delayed. And that's where you'll get something, I think probably Nike's probably a reasonable example of what you might see there, is where, they're sort of, over the last month, they're probably down sort of 15, 20%, depending upon where you want to measure from. And despite, there's been a bit of a bounce, but it's that type of thing where you'll see companies one by one reporting, and then the whole sector will fall, and then, they might bounce back a bit, but it's a, strategists have been warning about these types of things, but when the companies actually come out and finally go, yes, we're our profits are going to be lower, that's when you see, stock by stock, they'll all gradual, sector by sector, they'll all sort of gradually sort of factor in these downgrades.
Yeah, I mean, which raises the question: when would you buy? And typically, I look for, the more obvious start of a recession, when everyone's freaking out, was when I would expect stock prices to be looking to bottom, and we don't look like we're there yet to me. It's like when you start seeing 20,000, 30,000, 50,000 headcount cuts from S&P 500 companies, and that's when the recession proper has arrived, and that's when you'd be looking for bottom, I think.
And you've seen that you've seen the start of it from the pointier end, like the non-profitable, sort of some of the tech companies that are sort of the startups. You've started to see that all the cuts and things happening there. You just haven't seen that spread through to sort of the more mainstream companies yet. So if you're a long-term investor, buying now versus buying 6 months ago or 10 months ago is obviously pretty good. You've got in a lot lower than what it was 10 months ago, so that's not a bad thing. Your valuations are more normal. There might still be another 10-20% downside, but if you're just accumulating and you're not sort of trying to pick exactly the bottom, then now's obviously a much better level than recent times. It'll just be a question now of saying, do you want to try and wait for the exact bottom? Do you want to try and get it on the way up? We think there's a bit more downside, but current levels are not terrible in terms of getting in. And the other thing is keeping in mind that these cycles over the last couple of years have played out at a much more rapid pace than any other cycle. So when the bounce does come, it's probably going to be way faster than everyone expects. So starting to accumulate it at some point, whether now's the right time or not, but starting to accumulate at some point is a good idea.
And Damien, some of the conversations I have been having with some clients at the moment that are starting to buy is they're doing a dollar cost averaging strategy. They know now is much cheaper than at the start of the year, but they don't know when the bottom is. So over the next, if it's 6 months or 12 months, they're just regularly accumulating over that period. And then, they know over the longer term, they're likely, their holdings are going to be much higher over the long term.
Which is sensible stuff. So just to finish off our imbalances, there is the old chestnut, Australian consumer debt, obviously related to mortgages. And we're seeing, the beginnings of an unwind in this as the RBA has raised rates very aggressively. In fact, more aggressively than the Federal Reserve, if you factor in that they meet more often. Which
and started later,
and started later, yes.
Actually, let me just put that in context as well for people who weren't aware of it. So the Federal Reserve tends to meet every 6 weeks, whereas the RBA meets every month. So effectively, every 4 weeks the RBA has been raising rates by 50 basis points. Every 6 weeks the Fed's been raising rates by 75 basis points. So it's effectively the same speed of rate rises, despite the fact that inflation's been much lower and wage growth has been much lower in Australia.
Yes.
And debt's much higher. And well, anyway, we'll go through that.
Yes. Well, we probably don't need to reiterate that whole thing, but yes, all of that, and so the Australian, sort of monstrous Australian debt bubble has been quivering a little, and house prices are falling at their fastest since 1983, if not ever. And we don't expect that to change in the short term. I guess the question is, does this turn from a short cycle to a long cycle reckoning for this particular imbalance? I don't think so, because I think, as Damien mentioned, inflation here is low, especially wage inflation. We do have a big problem in some of our energy cartels, but I suspect the RBA will trim a lot of that inflation out of its core numbers over time if it has to, if that inflation persists. Excuse me. And critically, we just don't have strong wage inflation. It's still like 2.6, 0.7. Some of the leading indicators are up to kind of 2.9-ish. But you could tack another 100 basis points on that and still not be terribly panicked if you're up at 3.9 at this stage of the cycle, with the globe rolling over and an enormous wave of cheap foreign labour about to flow into the economy over the next 12 months as immigration returns. So not a big inflation problem here, not sticky, I don't think, like it is in the US. I think that's largely based on wage inflation and services. Now, there are rents here are a problem. That's going to be sticky. So I'm not saying it's not going to be something of an issue, but you can see from yesterday that the RBA is pretty cognizant of its own pet household debt bubble.
Well, pretty cognizant, saying they're starting to realise.
I think the fact that they're the first central bank to back out, they were the last to start, they're the first to back out.
Yeah, okay.
Like that, within the context of such aggressive tightening around the world, like I think they overcooked it, but I think as well they've got the yips. They're the first ones to get the yips, and I think this is why, this household debt imbalance. And we know that there are particular issues with it as well over the next 12 months, as we've got this fixed rate mortgage reset as well, which is an enormous pile of mortgages, something like 40% of the overall market, I think, which are all going to reset onto much higher rates, from COVID low interest rates to floating rates, and that's going to be a big consumption shock for Australia, because it's not really so much about house prices, because they're existing mortgages, unless people get into sort of forced sales situations, but it will be a big economic shock because, all of that new repayment stress to banks is going to come out of discretionary income. So that's going to really hit consumption. My view is that we won't see a short-term tipping into long-term adjustment for this. It'll just be another cyclical downturn for Australian household debt and mortgages and house prices, albeit a deeper one than we've seen in some decades. But there are a lot of levers for both the banks and regulators to pull, and don't forget that they're basically in bed with one another. In Australia, it's not like this is a arm's length regulated market. It's not. It's all of those fiscal resources, monetary resources, macroprudential resources, they're all available to the banks if real stress arrives. So I would expect they'll manage through this, even though it should be a deeper downturn than we've seen in many years. Excuse me.
So despite that, so it could be, so the net effect though is, it could be a ground. There's certainly reasons to lots of reasons to see that such fast rises over such a short period of time. If they delay in terms of all those remediation acts, there can easily be an accident that turns into a much lower one. But as you're saying, David, it's you can the support they're going to get means that you can ameliorate those problems and not turn it into the massive end of cycle result. But there's still the potential it's a massive end of cycle. It's just it's not the base case.
Look, yeah, that's right. Of course, there's tail risk here. Yes, I just wouldn't say it was the base case. That said, I do think, assuming the Fed goes as far as further and as far as we think it will, then and we get a global recession, then I think Australia has a recession too. I mean, whether you want to find that in the numbers or not, it will effectively be one, even if it's hidden by mass immigration. So, there we have it. So just, I guess, flipping over to how we see markets playing out for the time being. We've been pretty good on the FX so far, and we don't see that changing yet, even though we've seen this incredible kind of blow off in the US dollar, because we don't think the Fed's ready to ease back. We think that's probably got another leg in it. Similar argument for yields. Although, with the RBA backing off, Australian yields are looking, or bonds are looking much stronger than US now. And in fact, the 10-year yield, which in Australia has been positive versus the US or for the last couple of years, I think largely because global markets lost faith in the RBA. That's about to invert again, and we're about to go negative versus US yields. But we would still follow them up if they do spike. So base case is a global recession, I think. Lower equity still, maybe another 20% downside, who knows? I think the idea of dollar averaging is very good. And
it's an earnings story at the moment.
Yes, an earnings story. We've had the price derating, but now we've got the earnings issue to confront. Lower house prices, most certainly. And I think, lower commodities still as well. We've seen OPEC cut oil over the last day, and I've certainly become more bullish on oil over the last few months, partly because of OPEC, but actually more so because it turns out that the US shalers are less inclined to invest these days and more inclined to deliver enormous dividends to their investor base. So that looks like a structural change, which is going to give us higher oil over the longer term. But that being said, I still see the cyclical...
And maybe not the longer term so much as the short to mid-term.
Or the medium term.
Yes.
Yeah. Obviously.
Longer term, the higher oil price will accelerate the speed to
yes.
across to EVs.
Absolutely. I mean medium term, sort of 3 years, I guess. But as China struggles through this global recession, I think, most of the metals and the bulks, etc., all have legs lower. And then this is a deflationary base case for 2023. Certainly inflation coming down and some parts of the world being heavily deflationary. So I guess I would add one caveat to this narrative, and that is, there's the one kind of strange outcome that we might see is if we did get a Lehman moment of some sort, could it possibly happen before the Federal Reserve was ready to pivot? That is, while we still have relatively strong inflation. And what would that mean if, say, for instance, a Credit Suisse went under and suddenly the Fed's forced to print to support the financial system versus, what it wants to do, which is tighten and squash inflation? Could that result in an inflationary outcome, an unexpected one, because we just never managed to squeeze inflation out of the system? Possibly. But in that event, you would expect to still see a pretty potent recession after such a shock. So I think that'd be deflationary. And as well, this is where the Bank of England comes in an interesting way, where we've seen the UK go through its self-inflicted crises over the last few weeks. What it's done is it's committed to some QE, so it's pegging the long end of its yield curve, whilst at the same time saying it wants to still continue to raise rates at the short end. So it wants to fight inflation while printing money, which is actually plausible to do, because in effect, all you're doing is printing to control your curve, which is, it is a little inflationary. But if you're also raising interest rates at the short end at the same time, and potentially at the long, just not allowing them to blow up, then you could potentially actually have a kind of printed tightening. So I'll leave you with that rather unusual circumstance. And that's about it for our Lehman assessment.
Thanks for that, Dave. We do have a question from Web Access 11. So and this is quite typical of lots of conversations I'm having with people at the moment. He's saying he's got a property settlement in a week, and he's wondering where to put the funds to keep them safe. So he's saying he wants to stay out of property for 6 to 12 months. The obvious answer is to put the money in the bank, cash in the bank, but he's worried about global banking situation and possible bank bail-ins. So do you have any sort of commentary around that?
Well, I mean, personally, I'm not a believer in the likelihood of Australian bank bail-ins, in part because I don't see us going through this long cycle reckoning at this point. Like, I think even if we had a really big recession and accident, we still have, the fiscal and monetary resources to bail it out. And I still think that any bail-in, although I accept there have been, legislative changes to APRA rules and stuff that could enable bail-in, I just think it would be so unbelievably unpopular politically that I'm just not sure it's possible. And although there may be very powerful interests that were pursuing it, I mean, the Australian politician, the one thing that they probably would respond to is that's that scale of pressure from households who are going to lose savings. For that to happen, I think we'd have to see something really catastrophic.
Yeah. So the other thing to note then is, so that sort of basically says the big four are very likely to get some sort of bailout before you'd need a bail-in.
Yes.
If you're in a very small bank or credit union that's been doing the wrong thing, could one of those blow up? Absolutely. Would you lose your deposit? Unlikely, but
yeah, they wouldn't bail those in anyway. They'd just be bought by one of the majors overnight.
Probably.
managed by APRA. But yes, point taken. If you wanted the really safe option, stick it in a big bank.
And then the other one is
one bearing the brand of the sovereign is probably,
Yeah. And then the other one is government debt. Is go for some very short dated government bonds. 6 month or 1 year government bonds. As long as you're not. Look, the capital gain and loss on a 1 year bond is very low anyway. But if you're looking to hold it for that long, you're talking basis points of how much the capital value could go up and down, and you know what it's going to be at the end of it anyway, because you're getting $100 back or whatever. So I think if that's if you're really, really concerned, then it comes down to saying, well, do you think the Australian government's going to go broke in the next year and not be able to afford to pay its debt and not print money to bail itself out? I think that is extremely unlikely. And in any case, when countries do default, they almost always default on foreign investors. It is extremely rare that they have a default on local investors, because local investors vote, and so
which is the same argument as the bail-in, really.
Yeah, it's just you're one step closer. One step, I guess. There is a potential for it's a non-zero but very, very, very small chance that major banks could fall over and have to worry that. And then the Aussie Australian government.
And if you want to go full circle and say, well, that might happen, then buy crypto. Then you'd be taking some real risk.
No, that's a massive risk. Yeah, sorry, David's not saying buy crypto.
I'm not saying buy crypto.
He's got that
not at all. That
firmly in cheek.
Let me say that was a joke.
Yes, that's right. There's crypto assets will pitch themselves for that, but the volatility is extreme. So yes.
Yeah.
Excellent. Thanks, guys. So sounds like a very unlikely situation. So now we have our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. The question for this week is, which economic imbalance is likely to crumble first? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So that pretty much wraps us up for today. So Damien, thank you very much for sharing your insights. And Dave, thanks again also.
Pleasure.
Thanks.
Excellent. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email to contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you